Welcome to the third session in this series of training. Here we'll be exploring management information, which is split into this, part A, and part B, which is the next video. This series of videos is designed to help business owners and managers improve their financial awareness in order to be able to make better business decisions. Management information, or MI, falls into four main categories. Customers, so customer service data, customer retention, complaints, on-time, in-full deliveries, out of stocks, and so on. Systems and processes. This includes productivity data, energy usage data, e-commerce and social media data, CRM, ERP, and more. People, which includes staff engagement, absenteeism, staff turnover, social impact of the business on communities, environmental issues and your carbon footprint. And financial. This is the only area we'll be looking at here. In this session, we'll be making sure you understand some of the key pieces of financial management information that you need to support you in making the best decisions for your business. It's said that information is power, and there's no better application of this than getting the right MI to support your management decisions. In part A, we'll be looking to make sure you receive the right information at the right time to make the best decisions. This will vary for each business, but it's likely that you will need different information on a monthly, weekly, or even a daily basis to manage your risks and make the best decisions. We'll explore how to be sure the information you generate is meaningful for your business, i.e., it helps with the specific areas important to you. In this section, we'll also touch on what do I need to know? How do I program my accounts package to give me the answers? What needs to be input to achieve meaningful output? And do I need an advanced software package or MRP or ERP software? Next, we'll take a look at stock and how MI is critical to manage supplies, particularly for seasonal businesses. In the next video, part B, we'll look closer at profitability, considering what level of detail you need to be sure you're going to make sound, evidence-based decisions. We'll also consider how to compare the profitability of different products and different routes to market and channels. Finally, we'll look at how and when you should be forecasting and suggest ways to help you minimize any surprises. This will help you to proactively manage your relationships with customers and suppliers in our ever-changing world. MI is powerful and will influence both financial control and better decisions. All businesses are different, so you need to look at yours and decide, based on your risks and opportunities, when and how often you need to know certain things, such as how closely do I need to manage cash? How often do I need to know whether I'm producing my products profitably? How do I decide which new products to make or which new markets or customers to focus on? How often should I check on whether my customers are paying me in line with their terms? Am I paying my suppliers too quickly? And am I making and selling enough to cover my overheads and give me a return on what I've invested in my company? Consider what information you want to manage on a daily, weekly, monthly, seasonal, or annual basis. Information can be formal reports pulled out of your accounting package, or a simple spreadsheet where you manage and monitor a few key metrics. Whatever gives you the information needed to make good business decisions. People don't normally buy a piece of equipment and then think, what should I do with it? Normally, people consider what needs to be done and then look for the equipment that can achieve this. Accounting software and the way you choose to structure this is no different. You first of all need to consider what meaningful information you want to receive, and then find the software and software structure that will provide you with it. This session will take you through what you need to know, how you can structure your accounts to provide the best answers, what you need to input to get a meaningful output, and also, do you need an advanced software package or MRP or ERP software? There are probably quite a few things you need to know that are specific to your business. Therefore, we're not providing an exhaustive list, but a list of things that tend to be common to most food and drink companies. If you want to know that your product pricing is set correctly, you'll need your information systems to have the ability to show you the gross margin being made on each product. Similarly, you may want to know your gross margin by customer, sales channel, or business stream. Most accounting software packages enable you to establish this information. However, you'll need to decide which analysis is the most important to you. You're unlikely to be able to analyse by more than one or two methods unless you invest in quite sophisticated systems. These kinds of systems could be costly and demand a lot of effort in upkeep. A compromise might be to set your account system up to provide some analysis directly, but other analysis by downloading data into Excel for further analysis. The gross profit made from producing and selling your products will also have to cover your overheads. You'll also need to see the overall profit for the business, i.e. the net profit, paying particular attention to and understanding your fixed and variable costs, and how your systems might help you here. Ensuring that you're trading profitably does not necessarily mean that you'll be okay for cash. What is your information system telling you about your cash position? Key to all of this will be monies owed and monies owing in the short to medium term. Are you making best use of your systems to identify pinch points and potentially negotiate better terms? There are many other financial KPIs you might need to consider, depending on your own business needs. Examples of these could be stock turnover, debtor payment days, and liquidity, which is linked to cash flow, which looks at the ability to keep trading. All of these and more can be measured from data in your accounts package. Basic accounts packages tend to have more common features and capabilities, although they may look a bit different to one another. Other than very basic packages, there will normally be more than one way of analysing your accounting transactions. So first of all, decide what level of analysis you want out of your software. For example, do you want to know profitability per product group? Then, how do you go about achieving this? All accounts software will have a chart of accounts, sometimes referred to as the nominal ledger or general ledger. This is simply the first level of analysis for any business where income and expenditure is identified by type. Typical individual accounts within your chart of accounts will therefore be sales, raw materials, labour, utilities, fixed assets, and so on. And as you will not be trading entirely in cash, you will have other individual accounts for debtors, creditors, accruals, etc. It's best to keep your chart of accounts as simple as possible so that it doesn't constantly alter with changing circumstances. For example, you don't want to have to change your chart of accounts simply because you're launching a new product or taking on a new customer. Your chart of accounts would very quickly grow to a confusing and unmanageable state, restricting the useful level of information you can get out of it. Therefore, be sparing of your chart of accounts. You might break down your sales by import and export, or maybe by retail and wholesale. But don't be tempted to overanalyze. There are better places to do that than in your chart of accounts. For example, all accounts packages other than the very basic will also have a means of setting up customers and suppliers. Set them up correctly, and you'll be able to track sales by customer or purchases by supplier, as well as the more obvious amounts owed or owing, and any overdue receipts or payments. Working out profit generated from each customer might be more complicated than you think, and if this is required, it will probably be better done outside of the accounts package, but based on information extracted from the accounts package. If your chart of accounts is simple, where does the analysis by product type or business stream come from? Even the basic accounts packages tend to have at least one level of further analysis. Different software will have different terminology and methodologies, but the underlying logic remains the same. It's to provide secondary analysis. For example, Xero has functionality called Category Tracker. Sage 50 has Departments and Jobs. As an example, if you were a baker, you could possibly set this second level of analysis to be bread, cakes, and savouries. Or if you were a brewer, You could set this secondary level to be beers, lagers, and low alcohol. To be able to provide the answer to how much profit is being contributed by any given customer, or any given product or process, you need not only set up your chart of accounts and analysis codes correctly, you also need to be able to identify the direct costs with these analysis codes. These are typically raw materials and labour, but could also include machine costs and utilities. So, if you want to know how much profit is being contributed by a particular product, you need to know the sales revenue, the cost of materials that made it, the cost of labour that produced it, and quite possibly the machine time cost and utilities it took to produce it. This is entirely possible, but only if you have set up procedures to capture the information, and that information is input into your account, either directly into the account software package, or by keeping some other form of records, for example, an Excel model. Unless you have specific product runs for specific customers, you're unlikely to be able to do this by customer. To do this properly, you're going to need procedures for measuring the weight or volume of raw materials, time spent by operatives, machine time taken, and utilities used. If you've been correctly weighing the usage of raw materials, you will know the theoretical amount left in stock. As most of you will well know, more often than not, there'll be discrepancy between books and actual, caused by spillage and other losses. It's important to periodically measure physical stock, certainly month-end if you want meaningful monthly accounts, to establish true usage inclusive of spillage and losses. Physical stock takes should also include finished or part-finished stock. Unless you have very sophisticated systems, your accounts package is not going to know the answer to the amount of actual stock held. To make your accounts meaningful, you need to tell your accounts software about your opening and closing stock. Failure to do this is probably the most common error for distorting management accounts. There are systems, commonly referred to as MRP or ERP, that could automate some of these requirements. However, they do require considerable time and energy to set up and manage thereafter. Another common error is failure to record items at month-end that are not yet in the accounts. These items can include things such as goods or services received but not yet invoiced, products delivered but not yet invoiced, and products not delivered despite monies being received. We've stressed the importance of keeping track of stock if you want to have meaningful financial information. But the food and drink industry, traceability is a requirement anyway, of course. The way you manage traceability may well be useful in keeping track of stock levels. As you grow in size, you'll possibly find that manual or semi-manual methods of feeding stock and other production information into your accounts package is unsatisfactory. You may be reaching a point where you need to upgrade your systems to MRP, which is Materials Resource Planning Capability, or even ERP, Enterprise Resource Planning Capability. Some well-known and relatively basic software packages, such as Sage 50, have some capability in this area, but they all demand quite a lot of setting up and subsequent effort in their upkeep. Some top tips are: introduce MRP and ERP well before their absence is a real problem, but only if you truly think that they will be needed. Carefully specify what you want before starting the selection process. Make sure you have a knowledgeable implementation team with the time to carry out the installation. Make sure everyone is thoroughly trained and on board. And finally, be prepared for quite a large bill. The failure rate in trying to introduce MRP or ERP is high, and you'll probably need expert advice and support. Planning and preparation are key. Stock can include raw materials, packaging, work in progress, and finished goods. To run out of stock, either raw materials, finished goods, or packaging, is not a good place to be. However, having too much of either stock type is also not good financial management, especially in food and drink, where shelf lives can be short. In order to stay in control of stock levels and ensure A, you don't run out, and B, you don't have too much, there are processes that you can implement, including regular stock checks. most common failure in producing meaningful accounts is a failure to measure stock accurately and regularly. Forecasting tools and models to anticipate future sales and manage procurement and purchasing accordingly. Negotiating lead times with suppliers. And finally, drawdown arrangements with suppliers. Seasonal food and drink businesses have to make important decisions at key times of the year in order not to carry too much stock into the quiet season and to ensure they have enough for the busy periods. To assist with these decisions, a variety of MI is required, including historic trends and patterns from the same time last year, the year before, etc., for sales, stock levels, and so on. Accurate stock control and up-to-date balances, and forecast of future sales. See Part B of this session for more information about this. And finally, supplier lead times and delivery capability. Decisions for seasonal businesses can be much easier with the right MI. Your financial information should guide you in considering: do you have sufficient raw materials to produce stock for the Christmas or summer rush? Is there enough money in the bank to cover for the additional purchases and stock carry? Based on previous experience, do I have the resource to gear up production? Seasonal effects might, however, require more detailed accounting. Imagine you buy in a seasonal ingredient that is then used all year round. It might be a concentrated juice that is best bought when the season dictates, that is then used all year round. That might need to go to a stock code on the balance sheet with a charge to the P&L for sales of the product it makes. That way, the profitability isn't distorted by a seasonal purchase. Planning for a seasonal peak may consume cash much sooner than sales funds are received. Accounts should allow you to prioritise the sales that either offer cash back to the business soonest, that could be through e-commerce for example, or give you the best margin. This means the stock you build needs to be valued, sometimes because it either stays in the business across a month or even over the end of a financial year. The stock value therefore impacts the overall profitability of the business. And stock has several dimensions: the cost, the shelf life, the seasonal demand, and how much production cover the stock will provide for versus the lead time for replenishment or turnover. Although these cannot always be captured in management information, they do need to be captured. For example, running the business efficiently will mean having enough stock to cover the period of planned demand and production. Therefore, the optimal moment to reorder stock means that the minimum amount of additional cash is required to order again, to avoid an out-of-stock position. It sounds obvious, but accurately forecasting a seasonal uplift whilst anticipating any costs and cash requirements means MI allows you to make this critical judgment. Your account software therefore will need to work in conjunction with other planning and forecasting tools, for example Excel or ERP, to fairly and accurately reflect the stock value position. Whilst we can't cover the intricacies of getting stock management systems to talk to your accounts, it is important that the data is reflected in the accounts. In summary, in this session, we've looked at receiving the right MI at the right time. There are different needs for every business, but the key principles remain. How to make your financial information meaningful. What do you need to know? And finally, stock management and seasonal impacts. The importance of planning and reviewing the range of MI available to help you make the right decisions. The next video in the series, Management Information Part B, will look closer at information that helps you manage the profitability of the business. It will also look at profitability per product, per route to market, and per customer, as well as a brief look at the principle and benefits of financial forecasting. For now, it's goodbye.